Just a bit of background on me again. I lead Barnes Dennig's transaction advisory services team, where we take our clients, both buyers and sellers, through some of the very processes that we will be discussing throughout the series. From 2004 through 2018, I owned and operated Lucarelli Tactical Group, where my primary focus was doing mergers and acquisitions. We merged with Barnes Dennig in 2019 to create our Barnes Dennig Transaction Advisory Services division. In addition to guiding companies through mergers and acquisitions, we also assist with capital raising, financial management, and financial planning. Prior to 2004, I was a CFO for 2 public companies and a senior executive at Federated Department Stores in financial management. Lastly, I've been teaching MBA level classes in these matters for the past 21 years, and I'm a CPA. So a few housekeeping items before we get started. Just to remind about the CPE program does qualify for it, but you'll have to answer the poll questions. Number 2, we will hold sessions 3 through 6 on the next 4 consecutive Tuesdays at 1:30, just like today. So next week, November 10th, we'll cover the cost of capital and how to determine your expected return. On November 17th, the topic is valuation methodologies. On the 24th, we will cover how to finance an acquisition. And finally, December 1, our topic is the due diligence process and what to look for when buying, and for sellers, what to expect during that time frame. So the format today is some lecture on the topic of deal structures, and we'll also invite you to participate in the question and answer session as well. We ask that you would type your questions into the chat box, and we will get to them as time allows. Hopefully everyone's muted, and we'll just get started. Okay, so when you think about deal structures for buying or selling a company, particularly buying a company, there are 2 principal types. There's a stock purchase and there's an asset purchase. A stock purchase is simple. You're literally buying all of the equity or the majority shares of the equity of the seller. You're stepping right into the seller's shoes. The company continues on, and you're now the new owner. There's not really, in terms of administrivia, disruption of activities. There's no new company set up. There's generally, it's the company continues on with new ownership. So you throw the keys across the table and somebody else is now driving the bus. In an asset purchase, very different. In an asset purchase, what you're having happen is you are, as the buyer, purchasing selected assets and potentially assuming certain liabilities from the seller, but the seller company remains. And the seller is left with essentially a shell of the company, but you have now bought assets which you put into a new company that you establish. Now, there are some very significant legal, practical, and accounting differences that we need to talk about in conjunction with these 2 different structures. So Zach, if you want to put that slide up. Okay, the first, if you could go to, yeah. So the first topic is the legal consequences of the different deal types. From the buyer's perspective, buying stock is unfavorable legally, because what happens is the buyer, in the footnotes, takes on the legal liabilities of the seller post-closing. So if the seller has done some bad things, let's say they've defrauded customers or employees or short paid, they've done some bad things. Let's say that they have some outstanding insurance obligations or they have pending litigation. The buyer steps right into those shoes. As one can imagine, that makes it very daunting to do a stock purchase if you're a buyer. From a seller perspective, it's a favorable transaction to do a stock deal because the buyer takes responsibility for all the liabilities if they're disclosed, and the seller is essentially off the hook. Now, there's a big but to that, and it's this. Assuming the seller has fully disclosed all of the liabilities, of which we can't actually spell liabilities. I apologize for the typo, number 2. But assuming that the seller has disclosed liabilities, let's say he says, well, we've got pending litigation on a product liability lawsuit. We have a workers' comp claim. We have this, we have this, we have this. Assuming that that's all been disclosed and it's been understood and accepted by the buyer, then the seller is off the hook. And so the seller always wants to do a stock deal to alleviate them from having to have legal obligation going forward. From an asset purchase perspective, the buyer wants to buy assets. This gets technical, but essentially, when I'm buying assets as a buyer, the seller retains liabilities for prior acts. So it's important to know, if I'm a buyer and the seller did some bad things, if I buy assets, I'm essentially free from that contentiousness. However, as a seller, I also want, I don't like an asset purchase because I remain in the saddle for any outstanding obligations that the buyer has not assumed. And buyers don't typically step in the shoes of a seller who's got pending litigation or other claims. So this grid, stock purchases from a legal perspective, unfavorable for the buyer, favorable for the seller. Asset purchases, favorable for the buyer, unfavorable for the seller. Now there are practical consequences as well. Next slide. Zach, next slide. Okay. Next slide. Okay. Practical consequences. From a buyer perspective, a stock purchase can be favorable because when the buyer buys the stock, the employees, vendors, and the customers and the company continue on. So there's no disruption to the company, to the business. And whereas to the seller, it's also favorable because the seller walks away with no legacy company to manage, doesn't have to close down his old company, doesn't have to file his final tax returns. That he walks away scot-free, and then the buyer now will file a tax return. The buyer will make due allocation of income between the buyer and the seller mid-year, whatever. Now, in terms of the buyer's perspective on an asset purchase can be very complex. And it can be complex because the buyer has to rehire all the employees, execute new contracts with vendors and customers. I'll give you a real life example where this becomes very problematic. We had a marketing firm that had a strong relationship with P&G, had it for 25 years. But as many of you can understand, building a relationship with Procter & Gamble is not something that's for the faint of heart. And to be able to be approved as a vendor, particularly a complex services vendor in the marketing and web development side for P&G, it can almost be a non-starter. And ultimately, it was so daunting that the only way to do that deal was to do a stock purchase. And even then, P&G has written into some of their contracts the ability to approve or not approve the new buyer. But at least from an asset purchase perspective, that was a non-starter, because if the assets were purchased and not the stock, the company that P&G had approved as a vendor would no longer be the provider, and that would kill the deal. Okay, so next slide. Let's talk about the tax consequences and accounting consequences of the deal. Next slide, Zach. This Zoom thing is not quite as integrated as we might like it to be. Apologies to everyone. The third slide down. One more. Okay. From a tax perspective, okay, I've got to get rid of this. Okay. From a tax perspective, the buyer buying stock It is a very negative condition, and I'll explain why when we go to the other side. From the seller perspective, it's very favorable. When a seller sells stock, if to the extent there's a gain on that sale, the seller gets capital gains treatment for the entire gain. Whereas when the buyer buys assets, the buyer is able to do what's called step up the assets to fair market value and depreciate those assets, as well as amortize goodwill over 15 years for tax purposes. So let's step back for a second. Let's say I pay $5 million for a company. And let's say that the company's book assets, fixed assets particularly, are fully depreciated. And let's just say for the sake of argument that's true, because we can take accelerated depreciation. So let's say the seller has fully depreciated all of his assets. In an asset purchase, if I buy those assets, I can mark them up. Let's say the fair market value is $2 million. Okay, so let's say I mark up the assets to $2 million. And then I have $3 million left of purchase price that goes to goodwill. So I could depreciate that $2 million. And let's say it's 5-year assets. And let's say most of them are 5-year assets. I can depreciate that $2 million over 5 years. And I can amortize the goodwill for tax purposes over 15 years. So you can see that's a very favorable tax posture to have as the buyer of assets. In a stock purchase, you cannot step up the assets and you cannot deduct goodwill for tax purposes. So it's a gigantic penalty to the buyer. Now, the seller does not want to sell assets as opposed to selling stock, because tax rules are such that if you're in a business of selling fixed assets and equipment, okay, but you're not. You're in the business of selling services or selling equipment, selling inventory, whatever. To the extent you have a gain, particularly on assets that are identifiable, that gain is taxed at ordinary income rates and not at capital gains rates. So the seller in an asset sale will incur gains taxed at ordinary income rates. So it can be a huge tax penalty. So often what happens is there is some sort of an agreement to share the tax benefits of a stock purchase or of an asset purchase. I'm sorry. And that is a negotiation point. So it's very, very important to understand the differences between stock and asset purchases. And I think we've covered them at this point. There are other differences, but these are the key issues. Let's move on to financing structures. So when we do evaluation on a company, we are valuing essentially the fixed assets and the enterprise value of the company, the goodwill. What do they do? What's their brand name? Now there's what's called a net working capital adjustment that's made as well. So you'll have a valuation of a company, and then you'll have on top of that what's called a net working capital adjustment. So let's say that I have current assets of $3 million and I have current liabilities of $2 million. So I have net working capital of $1 million. So oftentimes what we'll do is that will go to the benefit of the buyer, assuming that it's a consistent number. But let's assume that net working capital jumps all over the place. Let's assume that it goes from $1 million down to 200,000. It goes up to $1.6 million. What we typically will do is go back and look at what the average net working capital needed to be to run the business properly. This is a fairly complex calculation, but think of it this way. If I buy your company, and let's say I buy your stock, okay? And I essentially am getting all the assets, but there's a net working capital adjustment associated with it. Let's say that you have, think of it this way. Let's say in your business, like this is actually true in a number of Cincinnati businesses, very conservative companies. Let's say that you have $5 million in cash on the balance sheet. Well, and your business is worth $7 million. So now, plus another $7 million for enterprise value. So you're going to get a lot of that cash, if not all of that cash, back through a net working capital adjustment, because it's not necessary to run the company. But from a seller's perspective, sellers always say, well, if I have whatever my net working capital is, let's say current assets minus current liabilities, let's say that number is $1 million, then I should get that too. The problem with that is, to the extent you rob the current assets of liquidity. To the extent you pull that out, the buyer has to not only buy the company with and whatever cash outlay, then has to go borrow more money to pay the current liabilities and payroll and other things, rents, day one, day two, day three. So what we try to do is measure current assets and leave enough current assets in the company such that the buyer is cash neutral until he starts earning cash flow from sales he made. So let's take a company that's on 30-day terms and you've got receivables out there. So you would expect the first day after you buy the company, you're going to get 1/30 of your accounts receivable in cash, right? But you're also going to have payables and you're going to have payroll and you're going to have rent and other expenses. So what we try to do is measure how much cash do we need between cash, receivables, inventory, do we need to leave in the company such that the buyer is essentially cash flow neutral as to current assets and current liabilities, so that if the buyer were to continue the business exactly as you were running it, would not have to go borrow more money on a line of credit. Now, this is again, it's a fairly complex topic, and it's also the topic of much debate in the construct of deals. I would say this is probably the biggest area of disagreement and contentiousness in doing deals. So it's just understand, if you're a seller, don't expect you're going to pull away all your net current assets against current liabilities. You're just not going to get to do that. I mean, it's possible, but you're going to take a hit on the purchase price if you do that, because no buyer wants to go pay a bunch of money to buy a company and then turn around and have to borrow more money day one to keep the doors open. That's not the way these deals get done. So I'll just leave that there. You can take down the tax consequences, Zach. So let's talk about how these deals, what the financing structures look like. And there's all different kinds of financing structures, but the typical, I'll say, reasonable deal is to borrow money from a conventional lender depends on how fluid or how liquid the buyer is, but a standard deal for us is where we would go to the bank and try to borrow low cost money from the bank, maybe 3-to-1 debt to equity ratio. So 75% of the capital structure would be in senior debt. That means we have to come up with 25% in equity as the buyer. Now, there's two different ways you can do this. I mean, there's more than two, but there are two primary ways. And this is sort of our standard go-to-market strategy, which is obviously the buyer has to put cash into the deal, but the buyer also may compel the seller to take what's called a seller note. And that seller note would be to the extent of maybe 15-20% of the deal. And so why would we want the seller to participate? And I think for most of us, it's fairly easy to understand, but imagine a world where a seller says, I absolutely don't want to carry any paper. I don't want to have to be on the hook for anything. It would make me nervous if I'm the buyer. What am I not hearing? Why would the buyer or seller be so convicted to not have any skin in the game? Because and we'll talk about this a little bit later, but the seller is making a lot of representations to the buyer, essentially promises about the customers and the vendors and the business prospects and the history, the employees. There's a lot of promises implicitly and explicitly that are being made. And if the seller is unwilling to carry any legacy liability, even for 2 or 3 years, it makes us very nervous. I can say this of all of the deals I've done in the last 5 years, I've not seen one deal where there was not a seller note. And sellers, I would say this too, the majority of sellers that come into our shop and talk to us about selling a company say, I don't want to carry a seller note. And my advice to them is, well, then we're going to have a hard time selling your company, or you're going to get a discount, because we're always fearful of what we don't know. And when there's no insurance policy in place, meaning the seller has agreed to carry some paper, it puts additional pressure on the buyer to know everything, and nobody can know everything. So, it's in fact, I cannot think of a circumstance where we have not asked for a seller note when we're representing a buyer. I just don't think it's good business, good practice to be all out there on the hook. And an additional ancillary benefit to this is that the banks feel very good when the seller is also taking a seller note, because that tells the bank that somebody else is also interested in the truthfulness and the veracity of what's been going on, and that the conveyances have probably been done properly. But you cannot be sure. So Zach, if you could put up the financing slide, I want to talk about conventional financing versus SBA financing, because both are viable means to fund the senior piece. Keep going. Keep going. Okay. Conventional acquisition term loans. So, I know that there are a lot of very conservative people out in our community, but borrowing 75% of purchase price is not unusual, and banks will finance up to 75% of the purchase price, assuming that there's decent collateral, good credit, strong operating history of the company, and cash flow. Typically, what banks are offering are acquisition term loans for 5 to 10 years. And the most popular right now are what are called 5-10 loans. It's a 5-year term with a 10-year principal amortization. So you'll get a 5-year loan, so it matures in 5 years, but you're going to amortize it and pay principal as if it's a 10-year loan. And what that does is it eases the cash flow burden on the buyer. So at the end of the 5th year, you have a balloon note, and the balloon note, you typically either pay it off if you've done really well, you pay it down, or you refinance it a second time and pay down that over another 5 years or whatever. The banks are looking for debt service coverage ratio of 1.25 or greater. And what that means is the banks don't want you to just be able to make your debt service payments. They want you to have a cushion. So if the debt service coverage ratio is 1.25 or greater, that means that you have cash flow that's 1.25 times the debt service. So you've got a 25% cushion there, essentially, of additional money available to you, so that you're not running the business so thin that you could miss a payment. That's a big deal. And calculating that is what you have to do is when you're looking at a purchase of a company, you have to run the future cash flows out by running projections. You then have to project out and load in the debt service that you're expecting, which is the principal payments and interest payments that the bank is requiring. And you run a ratio. And very, very often, this is a deal problem. Very often, what it means is we have to either lower the amount that we borrow, or we have to figure out how to improve the cash flows. Pretty hard to improve the numerator in that fraction when you're not even in the company yet. So typically what you have to do is borrow less by putting more equity into the deal. Typical conventional acquisition term loans will typically have prepayment provisions. So they don't want to go through all the work of underwriting the deal, getting you the credit, getting involved, doing the heavy lifting, and then 2 years later you go finance with another bank. Oftentimes with 2, 3, 4 year prepayment provisions. Will require personal guarantees. Period. End of discussion. This is another issue that just is constantly we're being asked, I'm not signing a personal guarantee. Now, I can envision that there may be super high net worth people out there that have the rationale of not doing that, but expect to have a personal guarantee placed on the deal. And years ago, and some of us are old enough to remember this, you could go in and do a signature loan for a couple $100,000 or $1 million and a signature loan. You could sign your name and that was good. Those days are gone. So personal guarantees, as well as oftentimes pledges of specific assets are required. So the less the less net worth the buyer has, the more likely they're going to have to pledge specific assets like their home or their securities account. But then personal guarantee is different in that it's just a promise, it's a guarantee from you, and the bank would have to sue you to get at those specific assets. But it's not unusual to see personal guarantees as well as pledges of specific assets. Now, if there is a seller note involved, meaning we've got the seller participating, let's say the seller is financing 20% of the deal, the bank will require an intercreditor agreement with the seller, meaning the bank, have the right through the intercreditor agreement to compel the buyer to stop making payments to you if we deem that their financial condition is teetering. So you're the seller, you have a 5-year note, you're expecting $1 million on a $5 million $5 million seller note. You're expecting $1 million plus interest the first year, and the bank looks at the deal and says, hey, they're barely making the debt service coverage ratio of 1.01. We're freezing payments to the seller. And so the intercreditor agreement subordinates the seller note to the senior note. And of course, that can be difficult for some sellers, but there again, if you are not planning to carry a seller note and sign an intercreditor agreement, you're going to have a very difficult time selling your business in this economy. It just is exceedingly difficult. I probably wouldn't want to take it on. We had a deal, just finished a deal 2 months ago, and at the last minute, the seller, who was my client, changed his mind about signing the intercreditor agreement. And we just iced the deal for about a month until he came to his senses. The idea that somebody else is going to, the senior lender is going to offer favorable terms and be in first position, but not stop the subordinated note from pulling cash out of the business and putting it on unstable legs, it's not a good notion. Now, it's important to note that a conventional acquisition term loan can be used to purchase less than 100% of the company. Now, that's important to know because other types of financing, particularly SBA financing, do not allow that. If we could go to the next slide, let's talk about SBA loans. Now, this is not intended to be a primer on SBA financing, but it's important to the concept of doing a deal to know the basic provisions of an SBA loan. So the SBA has two primary loan packages, the 7A, which is the acquisition loan program, and then the bottom and lower, smaller letters, the 504, and that's used for real estate loans. We're not going to cover 504 loans here. But the acquisition loan program, the 7A, is where monies are actually lent by a conventional lender, but the SBA guarantees 85% of the loan. So if you default, the bank is only out 15% of the loan, which means the banks are going to get usually that from you as a down payment. So the banks like SBA loans because the SBA's covered them, and you can often get in for 10% down. And right now, on 7A, you can get up to 10 years. So where we had the conventional loans with the 5-10 provision, meaning 5-year loan term with a 10-year amortization. With the SBA, you can get a straight 10-year amortization, 10-year term loan. And so from a cash flow perspective, very favorable treatment. No prepayment penalties. You will have to make personal guarantees. They're going to look for the same kind of debt service coverage ratio because think about it this way. This whole PPP loan thing has confused everybody, including me. That's where the SBA was out there, changing all the rules and doing all kinds of different things. And they were doing it under the 7A loan program. But ignore all that stuff for now. As The 7A program is the banks are lending the money. The SBA is just saying, okay, we'll backstop you if it goes south. Okay. So the SBA is not lending you the money, and the SBA is not underwriting your deal. The bank is. And now there are a couple different levels of banks that interact with SBA loans. There's what's called a preferred SBA lender. Now those guys literally have the authority of the SBA to write the loans without the SBA even seeing it. And if you're not a preferred SBA lender, then the bank has to put the deal through the SBA, and they have to actually look at the documentation and approve it. It can take much longer, can be much more difficult to do. So, we work with SBA preferred lenders, and if the bank is not SBA and not a preferred lender, it's super painful to go down that road. Okay. So we've talked about money down. We've talked about a senior note. We've talked about seller financing, and we've talked about the conventional versus the SBA programs. So let's talk about some other things in the construct of the deal. So so you could get the purchase price, plus you could get a working capital adjustment. There's also a provision called an earnout that can be to the benefit of sellers. So I'll give you an example of where earnouts make sense. We had a deal where a guy had founded a company, and he made ergonomically correct chairs. And a very good company, very profitable. And over 35 years, he had introduced several new type products. And he had discerned over that time window that it takes about 3 years for a new product to really, really populate itself in the market and to hit a really strong run rate. Well, they had spent several $1 million coming up with and designing this very cool ergonomically correct chair that was a better thing than they had prior to. And they had launched it, and they were about a year into it. And he said, this thing is moving faster and growing faster than all of our other products combined. And I've got a couple $1 million invested in this thing. I want to be paid for that investment, because this thing is going to be a home run. And in 3 years, sales are going to be doubled. Profits are going to be doubled because of that product. And, I'm not giving it away for free. So what we did is wrote into the purchase agreement what's called an earnout provision, whereby the seller would get additional money over 3, 4, 5-year window for specific profits garnered by that product. So an earnout can be a way to mitigate some concerns about, well, I'm selling too soon, if that makes sense. Okay. Now, if we could, what I'd like to go back and talk about is, Zach, the slide that I think it's the third or fourth slide, where we've got some additional differences between asset and stock deals. I want to go back to that because it enters into the next set of discussions. Okay. We had it. Okay. So I'm gonna repeat myself on some of these issues, but there are other considerations that we need to talk about with asset and stock deals. And so from a legal perspective, we talked about that. From a company structure, we talked about that. All equity in a company transfers to the buyer. Seller of the old company retains the old shell. Tax implications: no asset step up in a stock deal. Significant goodwill booked, but it's not taxable. Under an asset sale, you get the tax benefits of asset step up and the taxability of goodwill. Financial liabilities: generally all financial obligations of the seller are assumed by the buyer. In an asset deal, the buyer may agree to assume selected financial liabilities or none. Tax filing: so in a stock deal, the company files a single tax return for the year, allocating profit between the buyer and seller. In an asset sale, the seller has his old company. He has to file his separate tax returns. The buyer starts up his new company. Both of them have a stub period return to file. It wasn't the full year. Contracts generally are unaffected in a stock deal. In an asset deal, the contracts are not assumable and must be redrafted and newly executed by the buyer. It's a big deal. Employees in a stock deal, they just keep on going. In a asset deal, they have to be rehired. So you're talking about the whole filling out the application. You're talking about signing the employee handbook. You're talking about filling out the I-9s, re-enrolling in the benefits program. Now, I will say this: many of the benefits insurers have the grandfather clause, where even in an asset deal, they will allow the benefits plan to continue as if it were a stock deal, because they don't want to have to restart deductibles and the like. So that's an important asterisk to this. And then tax obligations. So this is also, there's very few absolutes in any of this. For the most part, in a stock deal, any unfulfilled obligations fall to the buyer, and the buyer has to go, pay those taxes and then try to get a claim against the seller. In an asset deal, generally, there will be the seller is responsible for his own taxes. However, payroll and sales taxes may follow the assets and be assessed to the buyer. So this is sort of an asterisk as well. Very often, sellers think, or buyers think it's not my problem, but sales and payroll taxes can be assessed and collected from the buyer, and so it just puts additional heavy burden on the buyer to make sure that they vetted those tax positions very plainly. The deal we just closed 2 months ago, where my seller was getting antsy about subordinating his note, he also had certain tax issues that needed to be resolved, and the buyer was adamant that absent strong promises to take ownership of those issues in the purchase agreement, the deal was not going to happen. Okay, so I'm going to move on to a couple of other topics in the concept of doing a deal. So the process, which we talked about last week, is, two companies meet, they agree to start dating, then they think, well, let's get engaged. So they have a letter of intent. Now they're engaged, but they haven't gotten married yet. So we're in the due diligence phase, and we're drafting of the definitive purchase agreement. The definitive purchase agreement we talked about last week is like an encyclopedia about your company. Well, in that definitive purchase agreement, you as a seller are making specific promises and representations. We refer to them as representations and warranties. And representations are, there are no unasserted employee claims. There are no outstanding legal matters. There are no unpaid taxes. There are no vendor lawsuits. There are no this or that. And that. Okay, both positive as well as negative assertions that the seller is making. And the seller also is giving a warranty to the extent of, and if it turns out I'm incorrect, or if I didn't give you proper information, or if I forgot to tell you that we have these problems, I'll give you a warranty. I'll give you the ability to reduce the seller note, or make other adjustments, or send me a bill for the warranties that we didn't tell you that we had customer claims for warranties. There are warranties that can be built in and are built into the purchase agreement that you have to make. So the idea of, well, I just did a stock deal, and so he owns it all. But if I made an assertion in the stock deal that there are no lawsuits pending, and it turns out there's a lawsuit pending in Laurel County, Kentucky, and it just didn't find its way into the due diligence because they're not putting their lawsuits online, and it's not findable without tracking every single courthouse in America. If it turns out that there's a lawsuit pending in Laurel County, Kentucky, the seller is responsible to cover that. And he will have made warranties to that extent, even if it's a stock deal. So, even though you say, well, it's a stock deal, the buyer owns all the responsibilities, I may have to pay it, but I have a claim against the seller to reimburse me. Okay. If there are any questions at this point, send them on. I haven't seen any pop up, but maybe it's just me. Hang on. Let me click on my chat window. Okay. Okay. one other issue to think about, and it kind of goes along with this reps and warranties issue. One of the things that we will do in the course of a deal structure is oftentimes, let's say that we have a company, the seller says, our 20% customer, our biggest customer, has told us they're not sure if they're going to continue to order as much from us. They've talked about reducing their orders from where they are to maybe half of it because they're picking up another vendor. And you say, well, gosh, as the buyer, I still like the company, but I don't like the implication of that. So what we might do, and this is not, it's not rare. I mean, it's not typical and it's not rare. Okay. It's somewhere in the middle where you may create an escrow account. Let's say there's a $6 million transaction. And I say, well, I'm going to pay you $5 million and between seller note and, you take a seller note for $1 million and I'll pay you $4 million. And then we'll put another $1 million in an escrow account. And the escrow account will hold that money. It could be an attorney, whatever. And that money is held in escrow until whatever condition gave rise to the escrow account is otherwise extinguished. So if you say, well, if that customer cuts his purchasing down by 50%, that's going to be a $700,000 hit to gross margin. I'm going to hit the escrow account for that over the next 2 years. So that can be another vehicle whereby the deal is otherwise parsed out. So you could have in a deal an equity infusion by the buyer, a seller note, conventional financing, an earnout, and an escrow. You could have all of those in a deal. Now, that would be a fairly complicated deal, but wouldn't disqualify the deal. It's just the way it is. So I am going to now look at some of the questions. Okay, so key employees. May we want them delivered under an employment agreement as part of the deal? Absolutely. Absolutely. That could be an escrow issue that you could say if I don't get the benefit of, let's say, our service manager and our sales manager and our VP of operations, if one of those people walks, I need to be reimbursed to the tune of, twice their salary so that I can replace them and replace the efficiencies or lost efficiencies, whatever. So that is a very important issue, and it can come up. In fact, this last deal that we just did was very complex. My seller had to make representations that the three key people would stay, and actually there were warranties that there would be reimbursements out of the seller note for any loss of those people. One of them quit, and it was a $75,000 hit to the seller. He had to reimburse the buyer out of the seller note. So, okay. So question about the SBA fee seems high. Why would you go for an SBA loan? It seems like a last resort. To us, the SBA provides, oftentimes it's when you're in the service business particularly, and there are no assets or very few assets, it's extremely difficult to get conventional financing, extremely. And if you, so if there's no collateral, like we did 2 years ago, I did a software deal. Company sold software as a service. So they sold their product was online. You could, as an employer, you could open up a portal and your employees could go in and do their self-evaluation. And then you could do your evaluation of them. So this portal would contain those evaluations. It's a pretty cool product. And they were selling it to hospitals and big educational institutions, et cetera. Pretty good product. But there are no hard assets. I mean, the hard assets were computers and people's brains, the programmer brains. So you can't put an asset value on those. It's not collateral. You can be seized. So there was no way we were going to get that deal done as a conventional deal. And yeah, the SBA fees can be 3.5% of the deal size, but in many cases, it is, as the comment says, it can be the only choice. It can be the last resort. But it's, I've done, let's see, probably in the last 3 years, we've probably done 4 or 5 SBA deals, and the deals would not have happened absent the SBA. So I think it's important to know that, and it's not forever, nothing's forever. And if the other thing is philosophically, when you're looking to buy a company, if you believe that 3 or 4 percentage point hit up front is going to tank the deal, and if you would not do that deal because of that, then you probably shouldn't be buying a company. The typical buyer is one that goes in and says, I know there's risk doing a deal. If I can get 10-year financing at a reasonable rate, even if I got to pay points, it's worth it. So what recourse does a buyer typically have with regard to a seller note? Can I give an example? So what recourse does a buyer have with regard to a seller note? Well, if I'm purchasing a company and the seller and I owe the seller money, right? If I owe the seller money and the seller has misrepresented things, there's typically what's called a right of offset, where you can offset seller payments to the seller against the damage that's been incurred by the buyer. So that's a fairly typical and common practice, even when it doesn't exist, even when there is no specific explicit right of set off. Think of it this way: the seller has not represented something important or has misrepresented something important that could end up in litigation. You're holding their money as the buyer. You hold steady. Now I'm not giving legal advice here, but if you're the buyer and the seller is holding paper and they've defaulted on their promises, ultimately, if it's going to end up in court, everybody's going to lose. So I've seen it happen where there was not right of offset, but they essentially offset it. We had a deal of exactly this nature where we paid 50% of the purchase price and 50% was in the seller note. It turns out the seller had done some things that would violated building code, and we had $1 million loss. It was a stock deal. We offset that loss against the stock, the seller note, and we didn't end up in litigation on it. He knew he was in the wrong. If we would have gone to court, he would have lost. Is the Main Street lending program an option for the acquisition of a service company? What I'll say is that the Main Street program has been met with high skepticism by many, many banks. In fact, there are not many banks that are actually lending through it. Again, it's an SBA, or I'm sorry, it's not the SBA, it's the Federal Reserve, that's behind that. I don't recall specifically if service companies qualify. I don't specifically remember if they don't qualify either, so I can't answer that right now. What is the interest rate spread for a seller note? Usually we're doing seller notes at prime rate. We've had sellers that want a bigger number, but it's hard, even when we represent sellers, it's hard to get a bigger number unless the company is, the buyer is at high risk. And if the buyer is at high risk, he's probably not going to get a senior loan either. So what I would say is you're usually seeing seller notes at prime. If it goes below prime, sellers aren't happy at all. If it goes above prime, the buyers are feeling disadvantaged. So prime is almost always the number that we see. Okay. Any other questions at this point? Let's see. Key employees. I'm trying to read these questions as they come through. Is there anything that I'm missing at this point? If anybody's got any other questions, Let's go. Okay. Well, look, let's go back and recap. One final slide. Zach, why don't you put that slide up? And if anybody wants a copy of this presentation, or if anybody wants just copy the slides, feel free to let us know. Yeah. Go back to the other one. To me, this is the important distinction. There's more, go back. There's more distinctions than these, that are on the slide. Keep going there. There's more distinctions than these, but these are the big ones. And we do both stock and asset deals. We have a buyer right now buying stock, and we recognize that he's taking on certain potentials, but we feel real good about the seller. We've vetted him pretty plainly. We've looked high and low. We've done very thorough due diligence on him. And the problem is that he has specific contracts and relationships, ongoing contracts with several large institutions. And for us to go renegotiate those contracts that are half done, it'd be a non-starter. The seller would not do it, and our buyer doesn't want to do it. So we're going to negotiate some of the tax benefits that we would have otherwise gotten through step up and through amortization of goodwill on tax basis. We're going to get that through a negotiated settlement on the taxes. And both buyer and seller are willing to have that happen. So the step up is a big deal. The financial obligations is a big deal. And just the complexity of the deal is a big deal. These asset purchases are more common than stock purchases by far. In this segment, up to about $50 million in purchase price, the asset deals are way more common, but they're harder. And there's a lot that goes into making them happen. And you also have to consider the employees. If you have employees that are no longer being employed, they get nervous. They what do you do about tenure? What do you do about reinstating them for vacation pay? There's just a lot of questions and answers you have to go through. And from the seller perspective, you'd rather not have a shell of a company to have to close down. You'd rather just sell the whole shooting match and be done. Any other questions at this point? Okay. Well, here's the deal. The first couple of these sessions are more technical in nature. What I'm looking at a question, what's the interest rate spread on a seller note? Again, typically there's not a spread. It's typically three, right now it's prime rate. The next couple of sessions are really, to me, more interesting because we're going to be talking about the expected return on your investment, how to measure what you think a fair return is for an investment, how to size the investment. And then the next session, 2 weeks out, is how I'm doing business valuations, which is my favorite topic because it's a topic I've been teaching for 21 years, along with the rest of this stuff. But that's a lot more dynamic, a lot more interesting. And I hope you'll tune in for the next 4 sessions at this point. And if there's no other questions, I think we're going to sign off. Okay, Zach, I think we're good. I think we're good to go. Thanks everyone for participating. Appreciate it. Look forward to seeing you at the next one.